House prices will never be the same. Home prices have been growing faster than ever, but most people expect the Fed to lower the interest rate so the mortgage rates will be lowered down, and that will finally make buying a house possible for the most Americans. Unfortunately, that is not happening. The entire real estate market is broken, and right now it's about to get worse. So in this video, I'm going to explain to you how the government indirectly over the last 10 to 15 years systematically destroyed the entire housing market and made it impossible to buy a house for the average American. Houses has never been as expensive as they are right now in the entire history of the US. So if you're ready, give this video a thumbs up and let's dive right into it. Mortgage rates right now are as high as they have been back in the early 2000s or even late 1990s. But before that, interest rates were much higher than that, therefore mortgage rates were much higher than that. But back in the days, house prices have been much more affordable. So even though that the mortgage rate would be much more expensive, but home prices are much more affordable, it made it possible for people to buy a house. But right now, house prices have risen dramatically and mortgage rates are as high as they have been back in 1990s. And since 70% of all the houses in the US are being purchased with a mortgage, a small difference in the mortgage rates will have a substantial impact into overall price of the house, which is why over the last 10 to 20 years, the entire system has changed to actually lowering the interest rates, and most people don't literally care about the prices of the houses, even though they are rising dramatically faster. Because as long as we have low interest rates, most people would be able to afford the house. And that was the case probably over the last 15 years. But right now we have high mortgage rates and also very high house prices. If you're buying a house that costs $400,000, you're going to make a down payment of 20%. In this case, it's going to be around $80,000. So if you're actually getting a mortgage at 4% interest rate, which was the case back in 2021, the final price of the house would be $686,000. So you're overpaying by almost $300,000 for that house. But you don't care about that because as long as you can afford the monthly payment for that house, you will be able to afford that house. Most people will never be able to save straight away $400,000 to be able to afford the house. And even if they will ever save that much money over the course of 10, 20, or maybe in some cases 30 years, by that time, inflation is going to drive home prices to such a point that those $400,000 will not be the same as they are right now. Which is why it's much more important to have lower interest rates. So the dynamic of the market has changed drastically over the last 30 years to make sure that we focus on low mortgage rates and not the house prices. But we have focused so much on the mortgage rates that we let house prices to rise, and now we are failing in the mortgage rates, which is actually creating a double problem for the people who want to buy a house. Because if there is a single percentage difference in the mortgage rates, let's say the exact same example, but you are having a 5% interest rate on your mortgage or a 5% mortgage rate. Again, we don't have 5% mortgages right now. I'm just giving you a hypothetical example of how much a single percentage in difference is going to make in the final price. The final price of the house is going to be $773,000. That's almost an extra $100,000 if you're buying that house. That's twice the annual income of the average American. And if we are going to take it a bit more realistic and we are going to take a 7% mortgage rate, then the final price of the house is almost going to be $1 million. $957,000. So a house that's supposed to cost you $400,000 is finally going to rise to almost $1 million just because of the mortgage rates that we have right now, which are around 7%. We might still actually be able to lower down interest rates to around 3 to 4%, but that doesn't mean that mortgage rates are going to be lowered down to that much. And let me explain why. In the last meeting of the Federal Reserve did not actually lower interest rate but kept them frozen because of uncertainty about the market. However, there is something that a lot of people did not pay a lot of attention to, and I don't see people talking about that, and that is the balance sheet of the Fed. there is a way for the Federal Reserve to inject the economy with cheap money, but there is also a way to pull out that money out of the economy. Because if you're actually throwing so much money and you're causing massive inflation, how do you solve that inflation? It's not just by about increasing the interest rates. Yes, when the Fed has increased the interest rates from like 0% to 5.5%, there is a slower inflow of money to the economy. But how about all that money that already exists within the economy that is still causing massive inflation? A single dollar that is being printed by the Fed is going to multiply as it changes hands every single time. I took that money and I paid for somebody to fix my car. That mechanic took that money and bought something in the grocery store. The guy who owns the grocery store took that money and purchased something for his wife, and so on and so forth. So that money circulates within the economy, creating massive inflation, which is why the Fed has to pull out that money. And that's something that we call quantitative tightening. And prior to this month, the Federal Reserve used to take out $25 billion out of the economy every single month. And that made sense. But right now, if you look at the balance sheet of the Fed, it's around $7 trillion, and it's down from the $9 trillion because there was massive outflow of money out of the economy. But the job of the Fed to bring the $7 trillion into something closer to like $4 trillion or ideally $3.7 trillion is if we want to actually finally fix the problem with inflation. If we don't do that, that money will stay there and will continue causing so much inflation because you're not fixing the root cause of the problem. If we're actually taking out $25 billion out of the economy right now, it's gonna still take us around 8.3 years to come back to around $4 trillion. It's not 1 year, it's not 2 years, it's not 6 months, it's literally 8.3 years. That was the trajectory that the Fed was prior to March of 2025. But guess what the Fed did? They have actually lowered down or slowed down quantitative tightening from $25 billion to as low as $5 billion. So that is a huge decrease. So right now, we have to ask ourselves a question. How many years or how many months it is going to take the Federal Reserve to take all of that extra money out of the economy if it's only taking or injecting out of the economy $5 billion? At $5 billion quantitative tightening, it will take the Fed 41 years to bring the economy back to the pre-pandemic level. We're not talking about 2 or 3 or 5 years. We're not talking about 10 years. You're literally talking about something over 40 years. And that means that inflation most likely is not going to slow down. Again, I'm talking about real inflation, not the inflation numbers that the government is reporting to you. Because those numbers that you see on the screen from the CPI report, those numbers do not include house prices. Those numbers do not include the overall increase in prices within the economy. Those numbers include specifically what the Fed decided that is important to you, even though that's not important to you. What's important to you are the real house prices. What's important to you are the real mortgage rates. What's important to you is the real interest rates. Those things are not included in the inflation report, which is why you should actually ignore it. And that's why, because of this specific reason, because we cannot fix the balance sheet over the next couple of years, inflation most likely is not going to actually lower down. Maybe yes, on paper, those inflation reports from the government will be slowed down, but the Fed knows that we cannot possibly risk to lower down interest rates. The banks are not understand what I'm telling you right now, and because of this reason, they're not going to lower down the mortgage rates in order to make it affordable for you, because they know that inflation is one thing and house prices are a completely different thing, and house prices will rise dramatically faster than that 3% inflation that the government is telling you, which is why do not rely on mortgage rates to be lowered down in the foreseeable future. But here's the interesting part. The banks don't make much money out of the mortgages for 30 years. So they take those mortgages for 30 years and they sell them to different organizations such as Freddie Mac. Those huge, large financial institutions, they buy those mortgages and they bundle them together into one type of a security that they call mortgage-backed securities, and they sell those mortgage-backed securities to investors who want very stable low returns, because the more stable your return is, the lower that return is going to be. So even though that those mortgage-backed securities will provide with 2 or 3% in interest rates, or maybe even 4%, those huge pension funds or those huge wealth funds from all across the globe, or investors with very deep pockets that want a stable return, will certainly buy those mortgage-backed securities. But because of the balance sheet of the Fed, more and more investors understand that those percentages, or those 2 or 3 percentages that those mortgage-backed securities could afford, will never actually be able to even make sure that the money that we have will grow at the exact same rate of inflation that we have. And I'm talking about the real inflation, which means that the demand for those mortgage-backed securities over the years is going to slow down, is going to go down, which means that banks will less likely be able to afford or to offer those low mortgage rates, because they know that they won't be able to bundle them together into mortgage-backed securities and sell them to those investors. The second reason why house prices are not going to come down is because we have systematically destroyed the system to make sure that there is never going to be a deflation in the market. And that's because the market can be divided into pre-2008 and after 2008. 2008 financial crisis had such a huge impact on the housing market, not just in the US, but all across the globe, that most people still don't realize how important or how impactful that crisis was over the entire economy, and specifically over the housing market. Prior to 2008, we were like, let's build as many homes as possible. The more homes are there, the better it is. Everybody can possibly be able to afford the house. But that led to such a bubble that the house prices started to collapse by 20%, 30%, 50%. And that's because there was a huge oversupply of houses in the market. And that oversupply led to a bubble, and the bubble crushed. But a deflationary mindset is much more dangerous within the economy than inflationary mindset. If prices are increasing, it's not literally that big of a deal, because we can kind of take measures to slow down prices. But on the other hand, if prices are falling down, that's a catastrophic impact. There is very little what the government or the Fed can do. Imagine prices are going down. Imagine house prices are going down. Are you going to buy a house? Well, absolutely not. You're going to think, I'm going to wait a bit more. I'm going to wait another day, second day, third day. Maybe I will wait a month, a year, 2 years. I will simply keep waiting for the prices to reach the bottom. You know, when you're actually trying to buy a stock and you look at that stock price and it's falling down, you're not buying it. You're waiting until it hits the bottom. The moment it starts rising, that's when you actually start buying that stock. And that's why the government wants to prevent a deflationary environment within the entire economy, which is why they have created a system to make sure that there is always undersupply of houses in the market. So they came out with different kind of laws. They made sure that it's very difficult to build houses for builders. They created laws that made it difficult for those builders to actually get licenses, and so on and so forth. Why do we want to do that? Because we don't want those builders to overflood the market with extra houses to the point where house prices are going to go down. At the end of the day, everything will come back to the basic laws of economics, demand and supply. If demand stays the same and the builders are going to oversupply the market with houses, house prices will go down and we will be back to the 2008 financial crisis. That's something that we cannot possibly afford. So let's make it in such a way that we can estimate how much demand there is for houses in the market. Hypothetically, let's say that there is a demand of 1,000 houses every single year in the market. This is just a hypothetical example. We as a government want to make sure that that demand is never fulfilled by 100%. That demand is fulfilled by 60 or 70%. So we are going to pass laws to make sure that there is only 700 houses being built in a single year. And there is a deficit of 20, 30, or maybe even 40% between supply and demand. And in such a way, there is always demand for houses, and the market is not going to turn into a huge bubble, but at the same time, house prices are not going to fall down. House prices will stably keep growing. And if you look at the graph of house prices, you will see that's exactly what has been happening over the last 15 years, or probably more than that, since 2008. Now we're in a position where, according to different kind of estimates, there is like almost 7.5 million houses that are being underdeveloped over the last 15 years. So there is a shortage of 7.5 million houses. Can we fix that problem overnight? Can we build 7.5 million houses? Well, absolutely not. It's going to take years for the government to fix that. That's the first problem. Second problem is that even if you get rid of all these regulations that the government came out from starting from 2008, it's still going to take the market to entirely adjust and be able to build so many houses. And again, don't forget the fact that every year the demand for houses still keeps rising. People are getting born, people are getting into the country, people are turning 18, 19, 20, and the demand for houses keeps rising. So we're still not even matching with that demand, leave alone that the shortage what we have accumulated over the last 15 to 20 years. 2008 also fundamentally changed the market by making it in such a way that buying a house is no longer a luxury or no longer a goal that most people viewed. Like back in 2007, the average price of the house, or the median price of the house, was $257,000. But when the market has crashed again, remember the mentality that I told you about? People don't buy a house when prices are going down. Yes, smart investors who know how the market works, they do that. But if you're talking about the general population, if you're talking about the general people, that's not what they do. They simply look, oh, house prices are going down year by year, we're not going to buy a house. But then prices started rising after that. And only in 2013, prices went back to the 2007 level. And since then, they have started growing gradually. This is when the interest to buy a house actually started rising, when people are like, oh, we want to buy a house. But then suddenly there was a small window of opportunity in 2020. And after that, it simply became impossible. Now prices are so high and mortgage rates are also so high that makes it impossible for people to buy. So prior to 2020, there was this window that people thought that, oh, buying a house makes no sense. This is a really bad idea. So let's not buy a house and simply go and rent a house, especially when we had low interest rates. Because if you simply go back to prior to 2020, interest rates weren't as high as they are right now. Like starting from 2008, up until 2022, this was probably the longest period in the entire history of the United States where we had the lowest interest rates ever. They have increased interest rates back in 2018 and 19 slightly to around 3% or probably 2.5%. I don't exactly remember. I have to double check, but they weren't more than 3.5%. And then 2020, and we had a crisis and we got them back to 0%. The third reason is that the cost of building houses is growing tremendously and has been growing and will continue to grow. And that's the fundamental problem. You see, buying a house or building a house, I would say in this case, is not an easy job. It's not like you can simply buy a house or build a house again. Building a house consists of multiple different components. You need aluminum, you need lumber, you need steel, you need cement, you need so and so and so. There is a very long list of things that you need. And when the prices of any of those things rise dramatically, that will have a direct impact in the prices of the house. That will have a direct impact on making building that house much more expensive. Back in 2020, the price of lumber was $277. Today, the price of lumber is $683. That's a lot of money, or that's a lot of increase. The price have almost tripled in such a short period of time. It has never been this high. Yes, there has been some spikes starting in 2020 where the pandemic happened, and then in 2022 when there was a conflict in Europe because Russia and Ukraine are some of the largest countries that produce lumber. And the problem is that most of the lumber that the United States imports from outside the United States or from the rest of the world comes from a country called Canada. And right now there is a trade war between the US and Canada, and that trade war means that there are extra tariffs that are being imposed on lumber. And that's why if you look carefully at lumber prices, they have been actually increasing lately. Now, I don't know how many years or how many months these tariffs are going to continue, but as long as we have these tariffs, the lumber prices are going to increase, which means that prices of building a house in the US are going to increase. Now you might say that, well, we can import lumber from other countries, or we can actually have our own lumber over here. That is all true, but you don't build factories or you don't build the entire supply chains overnight. It's gonna take time for the market to entirely adjust and make sure that that lumber is from the US, or to make sure that you import that lumber from other countries. Contracts must be signed, trade routes should be created, and businesses should agree between themselves. Prices of aluminium have also increased dramatically from $1,671 to $2,600. Since the United States also imports most of its aluminium from the rest of the world, because the aluminium industry in the United States have been actually dying slowly over the last 50 years. Producing aluminium is not a cheap endeavor. You actually need a lot of energy, and that a lot of energy is very expensive, which is why most businesses in the US do not want to do that, and it's much cheaper to import aluminium from the rest of the world. It's cheaper to get it from Canada, it's cheaper to get it from China, it's cheaper to get it from countries where energy prices are much more cheaper. But now by imposing tariffs on aluminium from all across the globe, bringing into the US is going to increase it dramatically, and that's why starting from 2025, you see that there is a rise in aluminium prices drastically from prior years, and that's because Donald Trump won the presidency and he imposed so many tariffs. Again, maybe over the long run, the market is going to adjust entirely and aluminium will be produced in the United States at a much cheaper price when there is going to be massive investments made. And because of the economies of scale, the prices of aluminium is going to go down. But that's not happening today. It is not happening next month. It's not happening next year. It will take a couple of years for that to happen. And finally, unemployment in the US has never been as low as it's right now. It's around 4%. That is a really great news for the economy where the unemployment is low. That means that there is a lot of jobs and people, anybody who wants to work can actually find a job. But that creates a completely different problem. When unemployment is so low, employers have to offer higher salaries in order to attract talent. Imagine you are a builder and you want to build houses. Of course, you need labor to do that. But with the prices or the salaries that you used to offer like a couple of years ago, nobody wants to work for that. People would rather go and work in IT companies. People would rather go and learn how to code. People would rather go and learn how to do artificial intelligence. They have so many opportunities. The question comes back to you. Why should people come and work for you for such a low salary? Which is why if you want to build a house, you're thinking, I'm going to offer much higher competitive wages for people to come and work and build houses with me in my company. And when you increase wages, you will take that higher wages and it will be reflected directly in the price of the house that you are building, which means that is another increase in house prices because wages have increased and had a direct impact on them. And these are basically the 4 reasons why house prices, first of all, are going to continue increase. And because of the first reason that we have talked about, mortgage rates are also going to increase. And that means that house prices are never going to be the same again unless we fix this problem. I honestly have no idea how they can possibly quickly fix the debt problem by overtaking or taking out of the economy those trillions of dollars to slow down the real inflation to make sure that house prices don't rise that much, and they will finally be able to lower down mortgage rates to something that is much more affordable, like 3 to 4%. But secondly, I can see how they can actually drive the cost of building houses much lower over the long run, but not in the foreseeable future. But by then, house prices can become so unaffordable that most people won't actually be able to do that.